Hello everyone, I'm Karan Dewan, Senior Executive at XSpot Wealth. Today we'll review the most significant market events of 2024 and share our expectations for 2025. So let's dive in. Despite initial pessimism stemming from geopolitical tensions and high interest rates, 2024 turned out to be a remarkable year for the global economy. The US economy exceeded all expectations with robust demand and historically low unemployment rates. Mid-year, central banks began cutting interest rates, with both ECB and the Fed reducing rates by 1% as inflation started to ease from the highs of 2023. Global stock markets also saw impressive growth, with AI leading the way as a focal point for investors. Last year was a standout year for equities, bolstered by the historical trend of strong market performance during the US election years. The S&P 500 rose by an impressive 25%. The Nasdaq, driven by the AI boom, delivered an outstanding 28.6%. European markets, however, lagged, with the Euro Stoxx 600 recording a modest rise of just 5.9%, reflecting on the ongoing challenges in the region's economy. At XSpot Wealth, our model portfolios have delivered exceptional performance. The flagship global growth portfolio with 100% equity exposure achieved a remarkable 25.6%, thanks to its significant allocation to US markets.
Hello, I'm Demetris Theophanides, Director of XSpot Partners Ltd. Today we will talk about the market expectations and economic predictions for 2025. To start, it is important to mention that we had two very good past years, since both 2023 and 2024 recorded strong upward performance without significant volatility. Entering 2025, we believe that it will be a year with somewhat greater volatility compared to the previous year. This year is likely to resemble mainly the second half of 2024, where in August-September we had sporadic but rapid increase in market volatility during the first sessions of both months, followed by prevailing buying interest, leading to another exceptional year for the indices. As we enter 2025, the main issue we encounter is the persistent strengthening of the dollar and the new increasing yields of American bonds, with yields reaching almost 5%. The main reason for this include investors' fears regarding the impending tariffs imposed by Trump, the fact that inflation remains above the Fed's 2% target, the strong labor market, and the rise in oil prices over the past few months. All this is happening while the Federal Reserve continues to promise new interest rate cuts for 2025, resulting in dovish Fed policies designed to stimulate economic growth and reduce unemployment. By lowering interest rates, borrowing becomes more affordable and encourages investments and consumer spending. However, dovish policies often bring exact opposite results of those intended. While dovish monetary policy can be effective in stimulating economic activity, it can also lead to inflationary pressures if left unchecked. The macroeconomic announcements of the first 3 months are expected to be very important in potentially determining the trend for the rest of 2025. We believe that investors' fears about the strong dollar and rising bond yields are somewhat exaggerated, and most likely we will see this trend to reverse. Donald Trump is expected to enter the White House with a pile of executive orders, which could trigger some volatility. However, we predict that Trump would ultimately adopt and implement more conservative manners, and he will be using aggressive rhetoric mainly as a negotiating tactic concerning China and other countries with which the new American president has opened fronts. We estimate that the first quarter will be crucial for the markets, with volatility expected to be somewhat higher compared to previous years. Yet now there are no major concerns, taking into consideration that interest rates at current relatively high levels were at these levels when inflation was significantly higher than it is now. Inflation remains at quite low levels and has stayed slightly above the Fed's target of 2%, but we do not believe that this changes the economic prospects for 2025. In conclusion, we believe that despite geopolitical tensions and policy changes, the global economic conditions are favorable. We will not be surprised if, despite market volatility, the major global indices will record another record year. In addition, bonds could be a critical element in portfolios and a source of diversifications to complement exposure to riskier assets, especially due to the capital preservation qualities of fixed income. Thank you for watching another analysis from XSpot Wealth. Stay tuned for more videos to follow, as we'll be here to monitor the markets and analyze more macroeconomic data.